Day trading is all about having a plan, and that plan starts with understanding your strategies. In this video, we'll explore 3 beginner-friendly strategies: scalping, momentum trading, and range trading. We'll break each down step by step, explaining every tool and concept you need to get started. By the end of this video, you'll have a clear understanding of these strategies and how to apply them confidently. Let's dive in. Scalping is like sprinting in a race. It's fast, intense, and requires precision. Scalpers make multiple small trades throughout the day, aiming to profit from tiny price movements. This strategy focuses on high liquidity and tight risk management. What is liquidity? Liquidity refers to how easily you can buy or sell an asset without causing a significant price change. For scalping, high liquidity is essential because it ensures you can enter and exit trades quickly. Stocks like Apple or Tesla, which have high trading volumes, are great for scalping. What is Level 2 data? Level 2 data is a tool that shows real-time bid and ask prices for a stock. It allows you to see the depth of the market, the number of buy and sell orders at different price levels. For example, if you see many buyers at $100 and sellers at $101, the stock might fluctuate between those prices. The process: pick highly liquid stocks. Focus on stocks with tight spreads, the difference between the bid and ask price. Use Level 2 data to time your trades. Monitor bid and ask sizes to anticipate short-term price movements. Set tight stop losses. A stop loss automatically closes your trade if the price moves against you by a set amount. Scalping requires you to limit losses quickly, typically no more than 0.1% to 0.2% below your entry price. Example: let's say Tesla is trading between $250 and $250.50. A scalper enters at $250.10 and exits at $250.30, locking in a 20-cent profit per share. For 500 shares, that's a $100 gain in a matter of minutes. But if the price drops to $250.05, a stop loss ensures the loss is only $25. Momentum trading is all about riding the wave. It focuses on identifying stocks with strong upward or downward trends, often triggered by major events or news. What is a catalyst? A catalyst is any event that causes a significant price movement. Examples include earnings reports, product launches, or economic news. For instance, if a company announces record profits, its stock may jump significantly. What is a breakout? A breakout occurs when a stock's price moves beyond a resistance level, a price it struggled to surpass. Breakouts signal strong momentum and often indicate further movement in the same direction. The process: look for catalysts. Scan news feeds or earnings reports to find stocks with big announcements. Confirm with volume spikes. High trading volume validates the strength of the price movement. Plan your entry and exit. Set your entry point just above the breakout level and your stop loss below it. Example: imagine a biotech company announces FDA approval for a new drug. Its stock jumps from $100 to $120. A momentum trader enters at $110 after confirming the breakout, targeting $115 as their exit point. If the price dips below $108, a stop loss minimizes losses. Range trading is a slower-paced strategy perfect for beginners. The goal is to buy at the bottom of a price range, known as support, and sell at the top, called resistance. What is a range? A range is the price area where a stock consistently moves between a low, which we call support, and a high, known as resistance. For example, if a stock typically trades between $45 and $50, those are its support and resistance levels. What is RSI? RSI, or Relative Strength Index, measures whether a stock is overbought, meaning it's likely to fall, or oversold, meaning it's likely to rise. RSI values below 30 suggest oversold conditions, a good time to buy. Values above 70 suggest overbought conditions, a good time to sell. The process involves a few key steps. First, identify clear ranges. Use historical charts to find stocks with well-defined support and resistance levels. Next, use RSI to confirm trades. An RSI below 30 near support confirms a buy signal, while an RSI above 70 near resistance confirms a sell signal. Finally, set profit targets and stop losses. Plan to exit near resistance and stop out below support. For example, imagine a stock trades between $45, the support, and $50, the resistance. A range trader buys at $45.50 when RSI is 28 and sets a target to sell at $49.50. If the stock drops below $44.50, a stop loss limits losses to $1 per share. Let's recap the 3 strategies we discussed. 1. Scalping focuses on fast, small trades in highly liquid stocks. By using tools like Level 2 data and tight stop losses, you can profit from tiny price movements while limiting risk. 2. Momentum trading allows you to capitalize on strong price trends triggered by catalysts. Look for breakouts, confirm with volume, and set clear profit targets. 3. Range trading is a structured, beginner-friendly strategy. You buy low at support, sell high at resistance, and use RSI to confirm your trades. Each strategy has its own strengths and challenges, so take the time to practice and determine which one fits your style. In the next video, we'll dive into more advanced strategies like breakout trading and news-based trading to help you take your skills to the next level. If you found this video helpful, don't forget to like, subscribe, and share it with others on their trading journey. Let us know in the comments which strategy you're excited to try.